Commonly when talking about velocity banking, the strategy is referenced using a HELOC to pay down debt faster. However, the strategy is not only relevant to paying down debt, such as a mortgage, typically leading to the question of how can I leverage velocity banking to help accelerate paying off my credit card. Well, in today's video, we're going to go over how velocity banking works with the credit card and go over an in-depth example. We'll take a closer look at some of the advantages of the strategy as well as some of the risks. For those new to the channel, welcome to Concepts Made Simple, where we aim to simplify everyday financial and self-improvement topics. If you're looking to get control of your finances and make smart financial decisions, be sure to like and subscribe to the channel down below. If you don't already have a good understanding of what velocity banking is, I first suggest watching our other video on this exact topic before watching this video. We'll leave a link to the video down below in the description. The first thing to do before starting velocity banking with the credit card is to write down your monthly income and expenses. Let's take a look at an example. Imagine that Grace currently has a monthly income of $4,000 and $3,500 in expenses. This leaves her with a monthly cash flow of $500. Next, Grace needs to evaluate which of her expenses cannot be put on her credit card. For Grace, her only expense fitting into this category is her rent, which is $1,250 per month and needs to be paid from her bank account. This information helps us understand what amount Grace can allocate to her credit card on a monthly basis. Grace currently has a credit card balance of $5,000 at an interest rate of 22% and a minimum monthly payment of $200. Please keep in mind that credit card interest is calculated on an average daily balance, meaning the bank will look at your balance on your card each day of the month, add all of those balances up, and then divide by the number of days in the month. They will then take this average to calculate the interest you owe. The next step is to put velocity banking into action. From Grace's $4,000 of monthly income, $1,250 will be left in her checking account to cover her mortgage, which cannot be paid on her credit card. This leaves Grace with $2,850 left in monthly income and $2,250 left in expenses to be paid. Next, Grace will take the $2,850 from her monthly income and put it all onto her credit card. By doing so, Grace will no longer have the $200 monthly expense for her credit card minimum payment, meaning that her expenses are now equal to $2,050. Let's take a closer look at what Grace is left with now. Before making any payment, Grace's credit card balance was $5,000, which would carry an interest of approximately $90.30. Instead, Grace took her income of $2,850 and put it all onto her credit card, leaving her with a balance of $2,150 on her credit card and $2,050 remaining in expenses, all of her expenses except her mortgage. Grace will then pay all of her expenses throughout the month onto her credit card. The key thing to note here is that not all of Grace's expenses will come out at once. By paying different bills at different times of the month, Grace will be able to secure a lower average daily balance throughout the month on her credit card. For example, say at the start of the month, Grace pays her hydro bill, which is $350. Then on the 10th, various subscriptions are charged, which adds up to a total of $150. On the 15th, Grace buys her groceries, which totals $400. On the 24th, $200 is spent on her bus pass. On the 27th, $300 for health insurance. On the 30th, another $300 is spent on groceries. And finally, her remaining $350 is spent across the month on entertainment. As you can see in this example, by paying all of her expenses through her credit card, Grace is able to lower her average daily balance as all of her expenses are not being paid at once, which in turn helps reduce the interest she owes each month. In this example, Grace is able to lower her average daily balance to approximately $3,100. Now, let's take a closer look at the total interest Grace will pay on her credit card with velocity banking versus if she just decided to use her monthly cash flow and allocate that towards her credit card. If Grace did not use Velocity Banking and paid all of her expenses through her checking account, she would be unable to lower her average daily balance during the month, as she would need to leave her income in her checking account to cover her expenses. So in our example, if Grace took her monthly cash flow and put it onto her credit card, she would be left with a balance of $4,500. Since no other expenses and payments are going onto her credit card, Grace's average daily balance would be $4,500, meaning she would owe approximately $82.35 in interest. On the other hand, with Velocity Banking, Grace has lowered her average daily balance down to $3,100 per month, meaning she would owe approximately $56.73 in interest. If Grace continues to use Velocity Banking, each month she will continue to lower her average daily balance, which will in turn reduce the amount of interest that she owes. By virtue of reducing the interest owed on her credit card, Grace will then have additional funds to put towards paying down the balance on her credit card. Grace will then continue this process of putting all of her monthly income on her credit card and then using the credit card to pay her expenses until her credit card is fully paid off. If Grace is able to stick to this strategy, she will end up paying down her credit card faster and saving on interest. And although this strategy can seem like a no-brainer, it's important to always speak with a licensed financial advisor who can help you evaluate your unique situation to see if a strategy like Velocity Banking is the right fit for you. There are many things to take into consideration before committing to a strategy like Velocity Banking. One of the major risks with Velocity Banking is a lack of discipline. If you're unable to create a plan and stick to it, the strategy can potentially cause more harm than good. In our example with Grace, she lowered her balance on her credit card, which in turn helped lower her interest owed. This is great, but what it also did was provide additional room on her credit card. If Grace then starts making additional unplanned purchases with this room, she can easily find herself in a worse place than when she started. Thank you for watching today's video, and as always, if you found the video to be helpful, please consider leaving a thumbs up and subscribing to the channel for more everyday financial content.